People keep looking at China's stock market and asking the wrong question. They ask, why is it so weak? Why doesn't it perform like America? And why does it feel so disappointing compared to the size of China's economy? Simple, because China's stock market is not built to do the same job America's market does. That's the whole point. In the US, the market is treated like a scoreboard. In China, it's often treated like a tool. And once you understand that, the underperformance makes a lot more sense. This is the first mistake. People look at the size of China's economy, then they look at the size of the stock market, and then they assume that the market should reflect national power the same way the US market does. But that only works if both systems are built around the same incentives. They are not. In America, the stock market is central. It is tied to retirement, wealth creation, corporate prestige, political confidence, consumer mood, and media attention. It's not just a financial market, it's part of the national identity. China is very different. The stock market matters, but it does not sit at the centre of the system in the same way. And this is often where people get uncomfortable, because Western investors want to believe all large economies eventually start behaving like America. China does not. China's economy is still heavily shaped by the state, and a lot of its biggest companies are either state-owned, state-backed, or heavily influenced by political priorities. That changes the game immediately. Because if a company exists partly to serve the national interest, then profit is not always the only goal. Sometimes stability matters more, sometimes employment matters more, sometimes strategic control matters more, and sometimes national power matters more. That means these companies are not always being run to maximize shareholder returns in the way US investors expect. And if that is true, the market will not behave like America's. In the US system, the incentive is brutally simple. Grow earnings, boost the stock price, reward shareholders, and keep capital happy. That's the culture, that's the machine. In China, the incentive structure is wider than that. Yes, profit matters, but profit for profit's sake is not always the top priority. The real question is often, how does this company serve the state? How does it support employment? How does it strengthen industrial policy? And how does it help long-term national goals? That creates a completely different kind of market. Investors want efficiency, the state wants control. And when control comes first, market performance often comes second. So when people say China's stock market does not perform well, they're usually describing the result of a deeper structural issue. The market is not broken by accident, it's limited by design. If political priorities override shareholder priorities, then valuations stay weaker. If private companies know the state can step in whenever it wants, confidence stays weaker. If the market is not the ultimate measure of success, capital behaves differently. That is why a massive country can have huge industrial power, world-class manufacturing, major global influence, and still have a stock market that does not inspire the same kind of belief as the US. Because the market is not the religion, the state is. Now, state-owned enterprises do not behave like normal capitalist companies. A normal company asks, how do we maximize returns? A state-linked company may ask, how do we secure energy? How do we maintain jobs? How do we support infrastructure? And how do we protect strategic industries? Those are not bad goals, but they are different goals, and the market prices that in. If investors believe a company is there to serve national policy before shareholder value, they will not give it the same kind of premium they give American firms built purely around profit growth. That's one of the biggest reasons China market has never fully got the same sort of incitement. And this is the part most people miss. If you want to understand America, you watch the stock market. If you want to understand China, that's not enough. You watch industrial policy, credit growth, property stress, export data, manufacturing strength, state direction, infrastructure, and strategic sectors. Because China's real economic story is often told through production and policy, not just equity prices. That's why using China's stock market as if it is the same kind of economic indicator as the S&P 500 is a mistake. It's not measuring the same system, and it's not even trying to. So, why does the China stock market underperform? It's because people keep judging it like it's an American market, and it's not. America uses markets as a scoreboard. China uses companies as a tool of national strategy. That means profit matters, but control matters more. And once you understand that, the weak market stops looking confusing and starts looking logical.